What happens if you invest every single month for 10 years, not once? Not occasionally. Not when the market feels safe. Every month, let's say you invest $500 per month. No stock picking tricks. No day trading. No trying to predict recessions. Just a simple, consistent investment into a diversified portfolio. Most people underestimate what that can do, because 10 years doesn't sound dramatic. It doesn't feel life-changing. It feels ordinary. And ordinary habits rarely get attention, but compounding does not need excitement. It needs time. It needs repetition. And it needs discipline, so let's look at the math. $500 per month for 10 years equals $60,000 invested in total. That is your contribution. Your earned income redirected toward your future. Now assume an average annual return of 8%. Not extreme. Not unrealistic. Historically, broad equity markets have averaged around this range over long periods. After 10 years, your portfolio does not sit at $60,000, it grows to roughly $92,000, depending on compounding frequency. More than $30,000 of that total did not come from your paycheck, it came from growth, from reinvested gains, from compounding returns, from money earning money. And here is the important part, you did not need perfect timing, you did not need advanced financial knowledge. You did not need to predict anything, you only needed consistency. That is the quiet power of monthly investing. Now let's take this one step further. What if you increase your investment slightly every year? Instead of keeping it fixed at $500 forever, you raise it by just 5% annually, not doubling it. Not making a dramatic jump. Just a small increase that often matches income growth. That single adjustment changes the outcome significantly, because now you are not only compounding returns, you are compounding contributions. Each year, your base becomes larger. And compounding works best on a larger base. Over 10 years, that small annual increase can add several thousand additional dollars to your final portfolio value, and the difference becomes even more dramatic over 20 or 30 years. This is why increasing your investment rate before increasing your lifestyle matters so much. Most people do the opposite. When income rises, expenses rise immediately. A better car, a larger home, more subscriptions, more recurring commitments. But disciplined investors treat income increases differently. They increase their contribution rate first. Even moving from 10% of income to 12% creates a long-term shift. Small percentage changes may feel insignificant today, but over time, they change the entire trajectory of your financial future. Consistency builds momentum, and momentum compounds. Now let's talk about what usually stops people from staying consistent: volatility. When markets decline, fear increases, headlines become dramatic, predictions become negative. And many investors pause their monthly contributions. But here is the paradox: market downturns are not interruptions to compounding, they are opportunities. When prices fall, your fixed monthly investment buys more shares. Those shares participate fully in the recovery. If you stop investing during downturns, you break the compounding cycle. If you continue investing, you strengthen it. The true advantage of monthly investing is not just average return, it is behavioral protection. Automation reduces emotion. Routine reduces hesitation. Consistency reduces regret. After 10 years, you may not feel suddenly wealthy, but you will have built something more powerful than a lucky trade. You will have built a system, a repeatable structure that works regardless of headlines. And systems create financial independence, because wealth is rarely built through dramatic moves, it is built through small, disciplined actions repeated over time. If you are not investing monthly yet, Start small, start with an amount that feels sustainable, then protect the habit, and when your income increases, increase your contribution before your lifestyle. Let time do the heavy lifting. Subscribe for practical investing strategies that help you build long-term wealth with structure and discipline.